Good afternoon. I welcome you to the panel session on understanding risk, which I will be chairing. I hope this panel discussion today with our expert guests will provide you with thought-provoking and informative, enjoyable afternoon. The aim of this session is to bring theory and practice together on the concept of risk and the management of risk. Maybe for me, to present myself briefly, I have been in the finance industry for the last 17 years, working as an analyst and then as a fund manager, and I'm more now interested in looking at rule-controlled trading systems. I have also the pleasure of being the journal director for the IFTA, and I welcome also our new guest on this stage today, Jeff Horman, who is a Director of Technical Strategy at Fidelity Worldwide Investment in London. He manages a team of technical analysts with whom he provides support to the equity fund manager and equity research analysts at both stock picking and macro asset allocation. And I think I don't have to present you Marcus this morning with his very lively, entertaining presentation, and David, who also very detailed presentation on technical analyst tool for risk. As we see, we will have a bit of specialization. Marcus is going to bring us nearer his views on the broader nature of risk and its application to the economic and financial system. Jeff is going to focus more on the risk seen from the practical side, that is on the day-to-day management of investment portfolio. And David is a practitioner as well, really focused on technical analysis. So I open now the discussion right away with maybe the first question that I have is how would you explain risk to a 6-year-old, a child? Because it's a very difficult concept to understand. So I don't know who wants to take the lead on that.
I think it is a really challenging question. I think that's, I think even talking about what uncertainty means to a 6-year-old is quite, or even to an adult, is quite challenging. And that's the sort of first component of this. It's about dealing with what uncertainty means. I mean, I think an interesting example is just, you know, if you take a coin, before I toss this, we're all uncertain about what the outcome is going to be, and we'll have a 50-50 is our way of saying this. But then I've tossed the coin, and it's actually landed now in one particular way. You know, there's no probability now involved in this. It is one way or the other, yet we don't have information. And so dealing with that lack of information is still why we will say, okay, well, it's still, to manage this, I have to say it's a 50-50 risk. But now I'm going to have a look, okay? I now know what the answer is. So it's interesting, it's your personal involvement with this data, and now I have more information. For me, there's no probability at all here. But for you, still, if you're going to take a punt on this, it's going to be a 50-50 chance. So, but I would question whether there's anything called probability at all. Because actually, you know, even before I started tossing this coin, why couldn't I go through the whole mechanism of the mechanics of this thing and know how it's going to land? Actually, there have been cases of people at the Ritz who've analysed how a ball go around a roulette wheel and managed to make a lot of money because they can make predictions using the physics of the thing. But I think actually risk is about your personal involvement then with this. What are the losses that are involved if I start to bet on this? For me, that's how it's your, I mean, I think the most beautiful example is this one called the St. Petersburg paradox, which is, you know, if I toss this coin, I will give you £2 if it lands heads, but I will give you £4 if it lands tails, then heads, and I will give you £8 if it lands tails, tails, then heads. Then the question is, well, how much would you actually pay to play this game? I mean, how many people would pay £100 to play this game in this room? Nobody? Really? That's very interesting. Did anyone put their hand up to say, so you think it's not worth £100 to play this game? How many people would pay £50 to play this game? There's somebody, yeah, there's somebody putting up there. Now, actually, if you make a mathematical analysis of this, the expectation value is that there's an infinite payout in this game. So actually, you should be prepared to bet anything on it, because in the long run, you will make an infinite amount of money. But of course, what you have now illustrated, I think, is what risk is about. Because you weren't prepared to play this game because of your psychological approach to, well, what am I going to lose versus what I have at the moment? And I think this game really illustrates people that, you know, why do people not bet anything on this game? Is because, and the different values that people will put on playing this game is, I think, a good measure of the risk for them personally in playing something which is, again, just about probabilities. But so it's about factoring in the extra thing, which is the amount of loss and the impact it will have on you.
Okay, so it's the probability of a negative effect.
Yes.
It has to be negative.
I think yes, I think it does probably have to be negative.
Okay.
And therefore, thinking about this out loud, the idea of conveying what risk means to a 6-year-old who has very little experience of what a negative outcome could be is much different than talking to a group of adults as you get older, because then you experience what more downsides can be. And hence, you have to approach it from a completely different perspective, because to a 6-year-old who's running potentially too fast down the street, that the parent would be alarmed that they might trip and fall and hurt themselves or get hit, is completely oblivious to the child, who thinks they're just having fun and they don't know about tripping and falling and if the car's coming, because to them it's only upside. So it's a different paradigm of perception, which is what I'm going to talk about a little bit to begin with anyhow.
Do you think that applies in the markets as well? Risk aversion or risk tolerance comes with actual wisdom and age. Young in the market is much more risk and aggressive to someone who's been in the market 20 years and experienced a huge amount more.
I think if you took the risk profile of most people who've been in the financial markets in their career path, and that's probably the case, that you embrace it younger and then you tend to become probably a bit more conservative as you get older.
So can you please also try to define risk for us now,
and I mean,
from your perspective?
From my perspective, I mean, risk can change dramatically from the tolerance of the person I'm talking to. So for one person's risk for one conversation can be completely different to the tolerance of risk for somebody else. It can be literally as simple of, this is the maximum amount I'm going to risk on this position, to not the risk of actually missing a sort of an actual profitable move in the first place. So actually missing out on a profit can be as much as a risk of actually taking a loss. And then I think it's interesting then, sort of, what are the risk conversations I may have with sort of clients and with sort of investors and traders. It can be about defining these very specific risk points and defining simply where we should put our stops, but also trying to sort of talk to people about the risk aversion that they have, and trying to get through the psychological biases that people have about wanting to run losses, not wanting to run winning positions, the gambler's fallacy of thinking if it's come up 10 heads in a row, it's going to come up tails on the next one. And so risk is a whole variety of conversations of getting through those different types of things, as much as just a straightforward, this is the fixed loss I'll have on a position.
Okay, so we see it's probability of negative effect, and every tolerance is very personal. But should we then say there are several? There is no definition of risk. There are several definitions of risk, and each of them are very personal. They are in function of this perception of risk. Are we talking about an absolute risk or a relative risk?
I definitely agree. I think there's different perceptions, and they have to be framed in the appropriate context. So me talking about risks involving the financial markets are my little world, which happens to do with investment management of portfolios, which will be completely different than potentially David's world or the professor's world, and how he approaches his within that framework. So it's very important to understand the game that you're playing, I think, within that context.
Yeah, I think if one takes another area where the word risk gets used a lot, which is health. So what it means to people, or if you're traveling in an aeroplane or a car. I mean, it's interesting that people may be told that their risk is higher of dying if they travel by car than by aeroplane. I mean, I think there's some story that says that actually more people died post 9/11 because they stopped flying and started going in cars than were actually killed on the day by the airplanes going into the World Trade Center. Now, it's interesting that, why do we have this? I think probably most of us feel that okay, yeah, I know when I'm sitting in turbulence in an aeroplane, I can go through the maths and say, well, I know that the risk involved is minute and I shouldn't worry, but I still do. Why is that? I think it's partly because when I'm driving my car, I feel I have some effect on the probabilities. So I think that my way that I drive a car can help improve my probabilities of avoiding an accident. I might be completely wrong, but again, it's the psychological effect that I think that the way that I drive my car changes my risk. So it's not relevant to look at large amount of data and say, well, there's a higher chance because I am playing a role in this. Whilst in the aeroplane, I feel I have absolutely no control at all. I can't change anything. And I think that's also true with health, that a lot of people will say, well, there's an increased probability that, the risk that when you go into a hospital, you might contract one of these nasty bacterial infections. But you will say, well, I know that I will behave in a way that will cut down my risk. And so I think that's important. The personal versus the sort of large numbers plays a role, I think, in understanding quite what risk means for every individual.
Yes, it's very personal, yes. Maybe to bounce also on one of the remarks you made this morning, saying that we're living in a random world, or maybe not totally random. Is risk totally random, or are there some non-random price development? I think we had it, but maybe if you could again expand on that. I thought the discussion was quite interesting this morning on that aspect. Whoever, the practical side would be then saying the trend following, or the...
Well, I'm prepared to have a kick-off on that one, because I'm interested actually whether there's... I mean, is there anything truly random? Does randomness exist? I mean, actually, if you have complete information, why can't you just run deterministic equations to decide what the outcome will be? Of course, we don't have complete information, and that's how we deal with lack of complete information. The uncertainty is that we have probability is, well, there are many situations, and this is how many will give me a win, and these how many will give me a loss. But I think it's kind of interesting to ask yourself, is there... a lot of people have asked me already, are the markets random? Well, I would question whether anything is random. If you go very fundamentally, then there is something which, at the moment, is believed to be fundamentally random, which is quantum physics. So, for example, when a piece of uranium is going to release some radioactivity, we have no story to be able to tell when that's going to happen. The only thing we have is a probabilistic model. Now, the question is, are we just lacking information about that model at the moment? But so I think it's about when you're asking, is something random? You might be asking. It might be important to ask a different question, because it's not about is it just what the impact of lack of information is going to be. This isn't a random system, but what does the impact of lack of information have on how I'm going to read into the future? I mean, if you have complete information on the markets, could you know everything?
I would only suggest that oftentimes one would have a reasonable amount of information, or a lot of, one could say, information, and still have an outcome that is less than expected, or the opposite of what was expected. And that happens quite often in the financial markets. So that's getting down to the point of how we go about having to look at risk in this paradigm of uncertainties, because you often find out that the best line up all the equations and dot all the I's and cross the T's, and you still end up with an outcome of which you did not expect, and that's something of which you have to deal with on a daily basis.
Mm-hmm.
I think it was interesting the second David today, it was appealing to the fact that, well, you now have access to a huge amount of data. At what point will that access, obviously a lot of incomplete data, you're not going to be able to perhaps make predictions, but if you had a very powerful computer, all the data, is it still going to not be predictable? Well, that's probably the role of the human being, which is...
I think that gets into the, I think David's talk was fascinating because of the pattern recognition software side of the world in terms of, what makes us, in a sense, redundant as humans in doing that job. And up until sort of now, we know we're not, because the human eye is the best pattern recognition software. But clearly, the route David's going down is started to change that. And interesting, David's route is going about what you can actually quantify as a pattern. At the moment, the software hasn't been able to quantify head and shoulders or double tops and that type of stuff. We haven't got to that point. But at some point, will we get to that point? And then how does the whole game change from then going forward? I genuinely think the interesting thing is states change all the time. For me, that we can see what I think is a clearly quite sort of non-random state suddenly appear into a random state, and then we have to be. You can have as much information. You think, well, this is a very stable state, and this will exist and persist, and then suddenly it can end. And so that dynamic system that changes all the time is risk in itself. From lulling you into that overconfidence about a position, the success of having the sort of the non-random trades and that sort of working in your favor, to suddenly that state changing, and overconfidence is another risk factor in there as well.
Okay. If we move on maybe to the practical side of risk, risk measurement. There are a lot of risk measurement out there, which are useful now in what we've been saying, which are the measures we should be using more. For example, standard deviation, things like beta, risk return, all these risk return measures that we have that include this variance, this deviation to the mean, are they useful as a practitioner to measure risk? Is that something maybe as a mathematician or...
I think that's probably, that end of the table is, it would be interesting to hear.
Useful, possibly complete, and definitive, definitely not. So we, as many do, use different measures of risk, looking at, as you said, standard deviation returns, Sharpe ratios, Sortino ratios, VARs, all these type of things that are post-fact correlations. We know, though, that they change. They can change very, very quickly, that the past is not always a reliable predictor of the future, and hence things that people's perception of, and also then the so-called quantifiable, are not one and the same. So you will often come to times when someone's experience, I think, counts as much, if not more, than just the numbers, and therefore you've got to take somewhat with a grain of salt some of these numbers that the computers just spit out at you, or the quants want us to believe. You've got an extremely risky portfolio because of this. There's always another way of spinning it, I think. So just we're aware of these facts, but we're not in a non-quantitative world driving portfolios because of these numbers.
Okay. And do you make a difference between these risk return measures and other ones, like more that focus on the downside risk, because we said risk is more probability of losing, like semi-deviation or other lower partial movement, statistic kind of tools in your organization?
I'm not quite sure I fully grasped the question. I apologize.
Just The first kind of tools, they tend to have a measure of, they measure the return in relation to the variance around the mean, so also in relation to the positive side, the volatility, but which is not focusing especially on the loss, whereas the other kind of measures, they focus more on the loss. Is that something that you see be using now more in your organization?
Somewhat. I mean, it's also important. Volatility is not necessarily risk, and I think that's important to realize, that volatility oftentimes should be embraced, and it's one of these things. We have to look at risk in the perception. Often it's put in a negative connotation, as we mentioned earlier. It started. Well, in portfolio management, probably one of the biggest risks is not taking enough risk. So if you don't take enough risk when you're in a measured environment, you have no chance of actually beating what you're trying to beat or you're measured against, whether that could be the person next to me, so-called our peer group, or a benchmark, whatever that is. By being passive, obviously you're not going to add any value whatsoever. So you have to sometimes embrace the volatility. I'm not sure if I completely answered the question, but that's kind of how we have to approach the situation. Okay. So we actively try to embrace risk within somewhat of a controlled probability environment.
That's the framework you have.
And that is, from my side of the world, I mean, I look at it also different because we're not getting into Sharpe ratios and things like that, particularly from where we look at. But the volatility side is a huge part, and people actually want volatility. They want to embrace the volatility to trade. And I very clearly remember through the last few months when Eurodollar started its decline and it was falling very aggressively. So you'd think typically, well, this is a great trade. This is a fantastic opportunity, but short Eurodollar is falling. But all the option traders I was speaking to were absolutely bemoaning it like anything because there was no volatility on the trade. And so they weren't participating in the trade. It was only in the latter stages when vol started to move that risk profile changed for those. So risk, again, is completely different to the audience we happen to be speaking to at any one point in time. So you would naturally think, well, Eurodollar trending very aggressively would be a fantastic trade. But for the options community, until the volatility moved on it, and they actually got that more volatile movement in it, it wasn't.
What sort of things are you feeding into? I mean, if you're trying to quantify risk, then what are the ingredients that you will feed into an equation for that?
I mean, I think for Jeff and I, it's probably going to be quite a different sort of concept.
Well, yes and no. I mean, there's a lot of different, if you wanted to do a risk profile based on different factor analyses, you can throw in many different macro factors, as we know. Interest rates rising or falling an extreme amount, oil price rising or falling, currencies rising or falling, some black swan type of thing. And that's the easy bit, actually, because the computer can look back in time and say, well, this has happened when, and it's going to throw out some probability of it possibly happening in the future. It's also not going to be 100% realistic, because we know real time, these things never turn out exactly as they did in the past. That's kind of the so-called quantifiable type of risk, of which, yes, you can go through these scenario analyses and point them out. I think the more subjective type of risks, of which from a fundamental house that we investors go through, are just that. They'll ask about the assumptions that you're making based on a business and the future of that business, and all these different events I described can affect their business. And it's how those managers kind of deal with them that we have to try to place. Is that a risk of which we're worth taking if this happens, and or do we believe that that's a managed risk? And it's as much believing that the company itself understands those risks and knows how to manage them.
Okay. Maybe moving towards the risk management. As we've seen that forecasting has its limitations because of randomness and these deterministic systems that are chaotic. And we have to accept to live with risk and take risk. What can we do about it? What kind of tools do we have, or how do we then go on to manage these things, knowing that we cannot, our forecasts are going to have their limitations? And maybe as a mathematician, do you have an idea how we could do that?
I think, as I said this morning, in a way, we're evolutionary very badly programmed to manage probabilities and risk. And that's why I think the role of quantifying things and understanding that quantification is really important, because most people just don't have that sort of mindset to be able to navigate that. And that's why, I mean, it's interesting, I think this reflects if something really bad outcome could happen to you because of something, it increases your sort of relationship with it. So even though it's incredibly unlikely, and so the risk is not worth being involved with, because of the story involved in it, you get very tied up in getting obsessed with, I mean, for example, the fact that there are, again, more people killed on roads in Israel than were killed by bombs coming over from Gaza, but the obsession is with the bombs from Gaza. That's not a sensible risk. If you actually start to analyse the numbers, then you've got a better way to navigate what your relationship is with those stories. And at the moment, people don't have a good sense of numbers at all. And I think that for me, that's partly why I got into the role that I'm in, because I spend a lot of my time doing fundamental mathematical research, but I've also dedicated a huge amount of my time trying to engage society with mathematics and science, because I think that's what empowers you to be able to make good decisions. So for me, part of managing this is making people sort of numerically literate, which I think is in some sense is what. Although I said we're evolutionary programmed to spot patterns very well, I think we're actually fighting against the way our brain is programmed to navigate numbers beyond 3.
Mm-hmm. Very quickly, and this is just a very quick question and away from the risk side, but then does it very irritate you, and the abuse of numbers and the abuse of statistics that you see on a day-to-day basis from governments, constantly all the time?
Well, I asked some journalists this, whether, are you knowingly misleading people or are you just stupid? Because, the sort of headline that you get that the increase probability, you're going to increase by 50% your chance of getting bowel cancer if you have bacon in the morning. Well, that's a very, to most people, that's very frightening. They think that, if you're going to have bacon, they're going to sort of somehow, it's twice as likely that they're going to get bowel cancer or something. But then if you change it into the actual data, well, yeah, if you take 1,000 people, there are 2 that are likely to get bowel cancer, and if you have bacon for breakfast every morning, then, that 2 will turn into 3. Well, now, your choice about whether you're going to have bacon in the morning is completely changed from that. It's the way the journalist has told that story is very frightening. Oh my gosh, if I have bacon, I'm going to have a 50% increase in the chance of getting bowel cancer. That sounds really significant. But if you say, it's not a good news story if you say, well, instead of 2 out of 1,000, 3 out of 1,000 will get bowel cancer. So what's interesting to me is how many journalists are actually doing this because they know that what they're doing is the wrong way to tell that story, but it just makes it sells more newspapers. Or how many actually don't realise that what they're saying is they believe the story that they're telling. So for me, it's very frustrating that the way that people tell stories about data can really change behaviour, because people just don't understand how to navigate what's being given to them.
But it's interesting because we do then see that in the market to an extent with the confirmation bias of having people holding a strong position, the crowds of the bull crowd or the bear crowd. And as trends develop, people seek out the confirmation for their own view. And so the wealth of data that's out there, the positive that confirms to their view of the world is taken and everything else is ignored. And so that dual sort of flow of statistics numbers is manipulated all the time in the financial markets, and there's another major risk source as well.
Yes, that's true. And if we move then to the tools to control or to handle risk, you touched about it, David, on technical analysis, some of the things you do. I have here a whole list of ideas what I heard today, but maybe could you also talk about the main maybe ones that you're using that you think are useful for?
From the technical side?
Yes.
Well, yes.
Or any you think is not only technical, but you mentioned money management or...
Yes, I mean, definitely within the level of what a portfolio does that has different types of so-called positions and therefore bets. It's interesting to see how people look at their level of perceived skill when they're making assigned bets to a portfolio. So the simple example is the following. Let's just say that you have decided that you found 50 names that you believe you want to own. So you have different ways that you can actually put those together in a portfolio. You can basically say, I have already done my homework and I've said that I want to own these 50 names. However, I have absolutely no clue if number 1 or number 49 is going to be better or worse than the other. So you could say, I'm going to put 2% of every name one of these ideas and let it go and not touch it for 6 months and see what happens. And some of those will go up more than the others and they'll go down the same. Others will say, I want and believe that I have a very strong idea here and a much lesser conviction on an idea down the bottom, and I'm going to therefore assign a very high probability of this one working and own more of it and very little of the other one. And that might work. You can have, though, with that type of outcome, the wrong, it comes out not as well because the high conviction idea basically doesn't play out as well as you expected, and the one that you had assigned very little actually does quite well. And what we tried to do, what I tried to do, is to make sure that people's so-called conviction and that number assigned to it is aligned with how the technical chart is actually reading, meaning if I feel it's a very lackluster or poorly performing stock within a very high conviction, or portfolio high conviction, then I definitely recommend we should possibly trim back the position side, because there's nothing wrong with buying more later when you have more conviction that the market is going to actually give you the benefit and make money for you. So there's an opportunity cost always with positions, and hence that's something when we do our fund reviews from the technical side, I always try to keep in mind to try to really make sure that the managers align their conviction with how the stock is actually making money or not making money for the portfolio, because that's very, very important. That's just one way of doing it. Okay.
And David, do you have something you want to stress also on the on this tool side?
I mean, still? I think sort of the most, well, I guess two things. One I would say is, one, when we're sort of talking to people about using technicals in the first place, one of the most sort of first things we always try and sort of talk to people about in terms of starting to use technical analysis and risk and just the nature of positions and trading is just that very simple trend following approach. And getting over this psychological hurdle of being stopped out of position. There's no problem about being stopped out of position if you're being stopped out of a profit. But there's something very psychologically tough to be stopped out of, even if you're at a profit. And people want to say, I took my profit at this point. It's psychologically pleasing. It sort of flatters the ego. So you want to say, I bought here and I sold here and I'm fantastic. And in reality, most of the time that can make sort of nice profits, but the biggest trades, the biggest success comes when we run the winning position, and we run a winning position and we exit out of those positions by being stopped out. So sort of trying to sort of get people over the psychological hurdle of actually an exit comes by being stopped is one of sort of the first things that we try and do. And then hopefully that way it can try and change the psychology of, of sort of cutting the losses quickly and running the winners and that whole framework. The other, so most of the time for people that I deal with, and be that sort of clients or internal traders, is the risk is very much just this is the capital they have. It's a very simple thing. This is how much they've got, and if they put this number of trades on, they'll lose their capital if they all go wrong. And it comes down to the finance and mathematics of how much we can risk on one position. What is the tolerance of each day of that position? How much do they put on one position, and how much do they put on a different position? So when I was talking about, I was obviously focusing more on retracements because in a sense that was the aim of the talk. What we're trying to do is identify those positions where we have a greater sort of odds in our favour that this will be a position to get into a trade, or this will be a position to get out of a trade, and those are the positions that we can then hopefully gear more capital behind. And where we don't have that, it will put less capital behind, or recommend less capital behind. So risk for us works on those sides, and on the day-to-day basis. Okay.
At this stage, I will see if there is already questions from the audience. Other than that, I can still ask a few questions, but I think it would be interesting to open for the audience as well.
I think there was a very interesting discussion about how you all look at risk. From my point of view, I work in a bank on the trading floor. I think from what I've seen is that people don't understand the nature of risk very well, even though they manage large sums of money. And if you look at some of the models in the past that have lost lots of money, they've traditionally been based on false assumptions. So if we talk about capital appreciation model, Black-Scholes model, which has flaws, or Gaussian theory, where you're typically taught that it has a kurtosis of 2, and we know that stock markets have a kurtosis much larger than that, typically about 4.5 or 5.5 particularly. And for me, even outside the financial markets, when you look at governments, how they measure risk is also incorrect. So if you use something like the Hurst component, which you use in hydraulics to measure, for example, how high to build a dam, we don't build for these big anomaly events very well. You know, these what we call black swan events. We think we understand the nature of risk, but evil people in power who control money, in my view, still don't really understand the true nature of how big a risk event can get, which is why you get these blow-ups in financial institutions. And in the real world, for me, you tend to cut a losing position when the pain of losing another dollar is bigger than the pain of being wrong. So my question would be, you know, do you believe that people that manage large sums of money, and also governments, etc., actually really understand the true nature of risk? Because I think they don't.
Okay.
Tom, I can only talk about the game that we play or the game that I play, meaning you're right, I don't disagree with you on some of the big pictures names you spent. I can tell you that the way in our game, which is basically trying to construct portfolios of, say, equity investments for growth that hopefully is going to come over X time frame, that we have a pretty good degree of the downside. It doesn't mean that you can eliminate or will eliminate the so-called downside, if that's what, you know, quote-unquote risk is. But in terms of being able to manage it, we have a fairly good idea. It doesn't, there are times when you own positions that obviously do not work out as intended and fall, and profit warnings that come, and management comes in and lies to your face and tells you in 2 weeks after they basically told you something 180 degrees different. That happens, and there's no way to avoid those situations. So you have to take that into consideration to the best of your ability when you're constructing the portfolios. But that's the difference between the skill of a good portfolio manager and someone, for instance, who's a good stock picker, but is not able to construct a portfolio that withstands the downside risks. So what you obviously want to avoid are the ones that fall 50%, because to get back to where you started from, you've got to double. So, you know, that's what I could say. But I think we manage quite a lot of money, and there's been very few times any where a so-called fund has completely so-called blown up over time. There's some that will underperform the benchmark potentially, you know, for periods of time, but very few that will lose so much money that they can't get that money back.
If I may maybe also chip in, most of the big companies, I think they have these constraints also that are given to them, that they have to be invested. They have a benchmark, they have a portfolio, they have to invest the portfolio according to certain benchmark. And this means also that taking now the quality of the risk, which has become much more systematic in a way, diversification then is not helping at all. And then you have these effects of fat tail, and you go down with it in a certain extent. If you could manage your portfolio really the way you would like to, not like the institution tells you to, well, you would cut your position, you would cut your risk, you would have no investment anymore. But I'm not sure you can do it in a real world always. That's a bit what I've seen at my place.
I would just add in also the opposite side of that, of say senior management not understanding the risk, is then it goes the opposite way, that they shut down the risk taking completely, because, and then we need risk, you know, in our job. We need risk to make money. And the other thing I've seen is, management actually shut down, essentially all that risk-taking, cutting the tolerances to such a fine degree because they don't understand, in a sense, what the potential sort of, in a sense, not the products they're dealing with, but the risks are. So go completely risk-averse, and that is something I think is very common. I guess the other one on that side is, that there are very skilled people that are not. Now, you can argue within big financial institutions, how much is that knowledge there, or when you get into, say, the hedge fund world, where it's much more specific, and you look at the sort of longevity of some of the big hedge funds and how well do they manage for those sort of black swan events. I think, the longevity in the market is probably the most telling thing, as much as the success of the portfolio.
I think also just, you have to be mathematically literate in order to be able to assess risk. How can you approach it otherwise? And I think what's most depressing is that if you look at government, the current government, there are fewer scientists, people with scientific or mathematical backgrounds elected this parliament than I think several before that. And they're having to make massive decisions about quantifying risk. What about our energy? How are we going to decide about what we're going to do for the energy crisis as it comes on? And this is about risk, because people's attitude to nuclear is about the fact that if it goes wrong, it seems to go wrong in a really, really bad way. And that's about, I think, that's all about managing risk. What is the, when it goes bad, how big a loss are you going to have? I think that's what, with somebody which has a huge portfolio, they can take much more risks on things than somebody who's just got a very small amount of money to. But actually, what are the probabilities then of that big event going? Have also got to be factored in, and then one makes a decision based on all of these things that you've quantified. But so much emotion gets in the way, and emotion is absolutely counter to what the numbers are very often telling you.
Yes, I have two questions, all for Professor Dr. Marcus. This is because I enjoy your brilliant speech this morning very much and just want to listen more from you.
That's very sweet.
Okay, so the first question is, say, what are the risks, say, to a mathematician? How do you mathematically assess the risk, and how do you proactively manage your risk? That's the first question. And the second question is regarding risk versus diversification. We learned from school that diversification can help you reduce risk, especially among assets with low correlations. But I remember, like Warren Buffett once put it this way: risk is something that about something like it's something that you don't know about something, and so diversification is like, say, protection against ignorance. So as a result, concentrating on a few things that you know is a better way to reduce your risk instead of diversification. Do you agree or disagree with him statistically or from whatever other perspective? Thank you.
It's interesting. For me, risk is actually very important, because when you're doing research, I think it's really important to open yourself up to failure. And we don't like to fail. I think there's even a statement on the front of the IFTA journal this time which says man likes to succeed, not fail, or something. What's the quote on the front? There's a quote on the front of the journal. Have you got it? But actually, I think this is absolutely the wrong approach. That for me, as a research mathematician, I think that I have to find as many ways to fail as possible, in some sense, because then the payoff is, and you have to deal with that failure. And if I don't take risks, I'm not going to make the big things that will change my field. And I think at the moment, I'm working under a sort of government which wants short-term results, impact, and we have to prove that what impact we have. And this so limits the way that I can be sort of imaginative in my research. It stops me taking risks, and it means that we're going to be a much poorer society because we're not actually going to make the great breakthroughs on prime numbers or something like this, because you have to manage failing. I think for an artist as well, there are many, many failures that an artist will do, but that's worth doing for the one thing where you actually win. So I think it's interesting. I think that I have to teach my PhD students to take many risks when they're doing research. The diversification thing, I think, is really interesting because in some sense I'm a big believer of what Deborah said this morning, that it's really important to find dialogue between different disciplines at the moment. I think all the big progress is being made, certainly scientifically, in all of the ways that subjects which used to be kept apart are being brought together. So for example, in Oxford, the mix of mathematics and biology is creating amazingly exciting progress. But diversification does, you do make a sacrifice because you don't specialise very quickly. So I think, the English system, we specialise very quickly in our subjects at the expense of that diversification, which can often mean we get, we have, I think, a disproportionate amount of Nobel Prize winners for such a small country, and that's partly because we have people who are able to go very quickly. But sometimes that's at the expense, and I think at the moment, perhaps diversification is where the new progress will be. And I'm all for having a school system where kids don't realise they're going, at the moment they go from maths to history to music to science, and they think they're all disconnected. But there's so many connections between all of these that it'd be wonderful to teach a curriculum, I think, where somehow you have that diversification sort of embedded into it because people don't realising they're studying different things. Men are born to succeed, not fail. Well, I think actually that's very interesting, but I think you have to open yourself up to the possibility of failure to succeed, and so you have to be prepared to manage that. It's about not taking, if you don't take risks, you don't make progress.
Hello, just an observation from an English literature graduate. Marcus, very cheeky. Is it mathematically literate or mathematically numerate? Now, on markets, or numerical, surely misinformation, lack of information, emotion, greed, and fear are all inherent parts of the market. Otherwise, there would be no market in the first place. If we had complete knowledge, there would be no other side to the trade. My question is, from a different angle, the saving grace for technical analysis surely is career risk. Do you have any comment on that?
Can I just have a go at the mathematically literate? Because it's very important to me that it is about literature, because mathematics is about storytelling, it's not about arithmetic. So for me, I think that a lot of people think mathematics is about arithmetic, and it's not about numeracy, it's about literacy.
Yes, indeed, and the market is a narrative.
Exactly, yeah, that's why it's fun to be involved in it.
What I meant by career risk was the trend-following nature of the market is largely to do with many players not wishing to lose their jobs.
Can you please elaborate? Trend players...
Sorry, I'm being unclear. What I meant by that was herd behavior is driven by people with positions on,
yes.
Not wanting to be the outlier, and people not taking risk when they think their job is at risk. So therefore, you get a lot of people jumping on trends halfway through, or usually too late, when the topping formation is underway, and that the profile of the market is just to a large degree affected by, or the herd behavior of the investment community is driven by the fact that people do not want to be the satellite to be cut off without their arms. Yes,
but the herd behavior is at the root of what makes the market non-random, and which is then a way that you can then profit from it. If you recognize it, then it's always the question, do you recognize it on time? Timely enough that you are not really at the last one of the herd. But I think if you try and work out a system that recognizes that, and you're aware of it, and you have also risk management tools to get you out, this is a way that I have back-tested and it works. So if I keep my job as well, I like it, that's true. if it does the job as well.
I was just going to say, we have to be very careful, I think, about making vast generalizations of what's right and wrong and what causes what, because, you know, I hear quite a lot of what I consider that's it's valid to a certain degree, and then it loses its validity. So I'm just trying to play a bit of devil's advocate. Just imagine a world without charts, right? Without visuals. We didn't have Bloomberg screens. We didn't have Reuters. All we had was the knowledge that there's a price, and yesterday maybe it was a bit higher than today, and tomorrow it would be a bit higher than yesterday, et cetera. And you had those some so-called fundamental knowledge. You knew that a so-called stock had earnings that looked like they were growing, and then they would continue to grow. And you knew you had a bit of information about maybe a valuation of that stock or the PE ratio or something. And to the successive buyer, they had that information as well. And their kind of framework was then, oh, it looks pretty interesting, and I still think the outlook is bright, so I'm going to buy some of that too. The same guy said that, or the different person said that yesterday, and that goes on and on and on. Now, eventually, you can look back, and 2 or 3 months later, you're going to have a trend because there's a natural buyer. That's not necessarily irrational. It's the question of course, the last one playing the hot potato when that so-called validity turns over, and they're going to be looking like the fool because they bought, and then others looked at the situation a bit differently, and they start selling before he did. But I don't think it's the so-called being, and that the technicals are always going to rescue you, but that's what we're trying to do with the technicals, to try to elicit behavior that part of the reason why these trends were occurring possibly are no longer valid, or at least it's not consensus anymore that it's no longer valid. That's just kind of my thoughts.
Okay. We arrive already at the end of the session. So maybe I take another question if you'd like to, but if there is really one pressing last question. Thank you.
This question is for the professor. I read a book by Peter Bernstein on risk, and he made an observation that action and the value attached to action and non-action is actually asymmetrical. Non-action has more value than action. I totally understand that. I applied it to my money management and trading, but I'm really interested in someone as great as yourself, a mathematician's take on that observation. Thank you.
I mean, that's very interesting. Over lunch, there seemed to be a feeling that action was more important than inaction. But you said the opposite. I think that's kind of striking, because you're only going to learn things through actually acting in the world and moving. And I'm not going to be able to understand my environment if I stay still. My area of expertise is symmetry. Now, I think it's very important to understand that although we're very sensitive to symmetry, actually a lot of logic is asymmetrical. If A then B doesn't mean if B then A, but we are so addicted to finding symmetry in the world because it's generally a message that often we can mix that up. And I think that, it's a more general point, but the idea of looking for asymmetries is often very important, because our intuition is often to place symmetry in places where there isn't any. So I think that, again, that's if you can understand an asymmetry in a situation, that's often something that will give you an advantage. It's not slightly the answer that you're asking for, but
I'd like just substantiate the observation a little bit. Peter Bernstein's argument is missed opportunities does not cost you any money. So therefore, non-action, and then you can, after taking non-action, you can take an action later on. As Warren Buffett puts it, investing is a baseball game without strikes. So.
Yeah, well, I don't know. I'm a believer in taking action rather than that's. I think that I'd rather lead a life which goes like this rather than flat lines, frankly.
Okay.
But that's a personal, not a mathematical take.
Good. Then thank you, ladies and gentlemen. Unfortunately, we need now to break this session. I would like to thank our panel guests for these very interesting discussions, as well as the audience for their lively participation, and our Max for the...
I'm going to take the risk now of walking along this.
Do that, yeah.
Thank you very much, Aurelia.
Oh, thank you.
Thank you, Jeff.
Thank you.
And I think when I have disagreements with people who don't trade, who say to me, you just gamble, Max, I say, no, I'm managing my risk. And I think that's what we all do, if we want to stay in the game at least. And I'd love to see you trading if you want to be out in the action the whole time. It's very interesting. Thank you very much.